Welcome to The Explainer. Today we're diving into why two of the absolute biggest names in retail, Home Depot and Lowe's, seem to be heading straight into, well, a perfect storm.
All right, so have you noticed this? You walk into a hardware store lately, and it just feels quiet. A little less chaotic, right? Well, there are two huge reasons for that, and we're going to unpack them. A housing market that's finally cooling off, and this looming threat of new tariffs.
Okay, so everything really kicks off with the housing market. I mean, after that absolutely wild post-pandemic boom, things are finally starting to cool down. And that chill, it's sending massive ripples through the entire retail sector.
So, just how bad is the mood out there? Well, let's look at builder confidence. Think of it as an optimism meter for the people who actually build our houses. Right now, that meter is sitting at 32. To put that in perspective, anything below 50 means builders are officially pessimistic. So yeah, 32? Not great. And look, this isn't just a one-off bad month. We're talking about 16 consecutive months of negative feelings. That's a really long time to be pessimistic, especially when it's coming from the folks on the front lines, the ones with the hammers and nails.
And here's where that pessimism hits the real world. This is the result. New housing starts, we're talking actual shovels in the ground, dropped by 4.6% in June. And think about it, fewer new homes means way fewer kitchens to remodel, fewer bathrooms to tile, and fewer gardens to plant.
So what's really driving all this? Well, it's like a domino effect. You've got these high mortgage rates, right, in the upper 6% range. That means buyer traffic is weak. People just aren't showing up. So inventory starts to pile up. It's actually up 33% from last year. And what happens then? Builders have to start offering incentives, cutting prices and throwing in perks just to move these houses.
All right, so with all that as a backdrop, how is the undisputed king of home improvement, Home Depot, actually holding up? Well, they just dropped their Q2 earnings, and it gives us our first really clear picture of what's going on.
At first glance, the numbers look massive. They reported sales of $45.3 billion. But, and this is a big but, Wall Street was expecting just a little bit more, at $45.5 billion. Now, it might seem like a tiny miss, but in this game, it's a huge signal that even a titan like Home Depot isn't immune to the slowdown.
But here's where it gets really interesting. The story isn't just how much was spent, but who was spending it. It looks like the everyday DIYer, the weekend warrior, is getting a little shy, especially on those big-ticket items over $1,000. The real growth? It's coming from the professional contractors, the pros. They've got to keep their projects going no matter what.
Okay, so Home Depot has laid its cards on the table. Naturally, all eyes are now swiveling to its biggest competitor, Lowe's. Their big report card is due on August 20th. And this sets up such a classic rivalry, right? A real tale of the tape. On one side, you have Home Depot's actual Q2 numbers, and on the other, you've got what the analysts think Lowe's is going to do. The burning question for everyone, especially investors, is this. Can Lowe's weather this storm as well as Home Depot? Is their own big push for pro customers actually working?
As if a cooling housing market wasn't enough of a headache, there's another major storm cloud on the horizon for these companies. We're talking about trade tariffs.
So, just a super quick refresher for anyone who needs it, what's a tariff? Simply put, it's a tax that the government puts on goods coming in from other countries. So that power drill, those light fixtures, if they're imported, they suddenly get more expensive for Home Depot to buy. And guess who that cost usually gets passed on to? Yep, us.
And this isn't just theoretical. We've got confirmation. Home Depot's own CFO, Richard McPhail, came right out and said it. They're planning, and I'm quoting here, modest price increases on certain imports. So it's happening.
And if you want to get a sense of just how big of a deal this is, look no further than a company like John Deere. They're projecting that tariffs will cost them $600 million annually. That is an absolutely massive number. And it just goes to show you what's at stake for any big company that relies on a global supply chain.
Okay, so we've got a slowing market and we've got rising prices. What in the world does this all mean for you? Well, whether you're a homeowner or an investor, we've broken down a little playbook to help you navigate all this uncertainty.
All right, for all the homeowners out there, the name of the game right now is strategy. Be smart about this. First, keep a super close eye on those mortgage rates. If they dip below 6%, that could be a golden opportunity. Second, shop smart. Look for those promotions and builder incentives. Maybe tackle some smaller projects. And third, think about upgrades that pay you back. Energy-efficient projects can often qualify for tax credits, which helps offset the cost.
And now for the investors. For you, it's all about doing your homework.
When those Lowe's numbers drop, compare them directly to Home Depot's. Pay really close attention to what the executives say on the earnings call, especially about tariffs and their guidance for the future. And of course, you know the drill. Diversify. Spreading your risk across the sector with an ETF might be a smart move right now.
Which, of course, brings us to the big final question. You've got a housing slowdown on one hand and a trade war on the other. Both Home Depot and Lowe's are sailing right into the same storm. They're facing the exact same headwinds. But their strategies are different, their customers are a little different, and that could lead to very different results. So it leaves us all wondering, who's going to navigate this thing better?